Traditional IRAs are the worst possible asset to own. That's a strong statement. And that statement came from Ed Slott, the number one expert in IRAs, CPAs in the country. And today we're going to unpack whether he's right and what it means for your retirement and your legacy.
Welcome back to Your Retirement Elevated. Walter Storholt alongside Scott Dugan of Elevated Retirement Group, financial advisor, always here to guide us through this financial landscape that's sometimes confusing, sometimes a little inflammatory. And good old Ed Slott made some pretty good noise recently, Scott, with this news that came out where he said this traditional IRA, this is the worst asset you can own. You said it right at the top that is just a bold statement, and it surely is. How did that strike you when you first saw it? I'm curious.
Well, I kind of chuckled because obviously there's a little bit of a showmanship in there.
Sure.
But I mean, I understand where he's coming from. And that's what we're going to talk about today. We're going to look at, why this matters more than ever after the recent, tax law changes. And more importantly, what can you do if you've already built up a big IRA? Because
I can imagine if I've got a big IRA and I'm hearing that, I'm like, oh boy.
Yeah. It's kind of like the guide, proper care and feeding of $1 million plus IRA is kind of what I should write a book about that. But that's really, it's crazy. We're right here in the Midwest. And people, I go to conferences all over the place. Oh, you're in the Midwest. We're in one of the 10th wealthiest counties in the country in Johnson County here, but we get calls from all over the country. I've got a call. So we're recording this on a Wednesday. I've got a call Friday morning from an IRA owner in California. He's got $5.1 million in his IRA.
Crazy. And
he saw one of our our previous episodes today. I want to talk to you about, what's going on with this. But if we frame this topic, who is Ed Slott? He's definitely the trusted IRA expert. He's nationally known, all types of books. He trains advisors, had a show on PBS for years. And he doesn't throw around words like worst possible asset lightly. Right. But his logic is definitely hard to ignore. But it all starts with a change in the law that affects how your IRA gets taxed when your kids inherit it. That's the big thing we're going to talk about today.
Okay. Now, I know a lot of this is, the IRA world was changed a little bit from the Secure Act. And I'm wondering, and I guess like the first one was 2019, pre-pandemic? Yes. It's like a whole lifetime ago, it feels like at this point. It's been through some other iterations, but is that kind of where a lot of this began?
Yeah, that started in 2019, the original Secure Act. It killed the stretch IRA for most non-spouse beneficiaries. And that used to let the kids stretch their inherited IRA withdrawals over their lifetime, spreading out that tax hit. Okay. And think about that year after year, you could just take a little bit out over their lifetime. That's why you could stretch it out. It was a fantastic planning tool. Now, 10-year rule. You have to empty that account within 10 years, and that can mean a massive tax bill, especially if someone's in their 40s or 50s or 60s and are already earning a really nice income. And I think I want to put it in proper context. When he's talking about this, he is talking about people that have large IRAs, and so they have some assets, and they're more than likely their beneficiaries are doing well. And you think about, when do people usually inherit an IRA? It's usually in their peak earning years, in their 50s, 60s on up. Mom and dad are in their 70s, 80s, or 90s. You used to be able, hey, we're going to get this $1 million IRA. We're going to stretch it over a lifetime. Not anymore. Let's say if you receive it at 55, you plan on retiring at 65, you're trying to maximize your income for the last 10 years, and you plop another $150,000 in ordinary income on top of your already savings, or your income. That can sometimes be a problem.
It makes tons of sense from the government standpoint to do this. I mean, with that exact scenario you've laid out, it's allowing the government to get the maximum amount of withdrawal for themselves in terms of what you're going to pay in those taxes.
Absolutely. And his point is, you're not leaving them money, you're leaving them a future tax bill, and they don't get a say.
Your beneficiaries.
The beneficiaries, yes.
Yeah.
And if you think about it, when you're deferring the taxes, we're talking about, hey, I'm going to put this in and defer it. And you're not only deferring the taxation, you're deferring the calculation, because the tax rates are unknown at the time. and we're in a low tax rate environment historically, what is that going to look like in 10 years, 20 years, 30 years when your beneficiaries receive this? So again, you're giving them a tax bill for sure, and it's unknown what that liability is going to look like.
Yeah. So why is a traditional IRA less attractive than, in addition to that reason, from the inheritance angle?
Well, traditional IRAs are great for tax-deferred accumulation, but they're poor legacy assets because everything is taxed at ordinary income when it's inherited, not capital gains. We don't get
That's a
step
big
up
difference
maintenance.
maker, right?
Huge, huge. And so another great quote from Ed Slott, he said, the IRA is the best wealth building tool during your lifetime, but the worst wealth transfer tool after you die or after your death. So again, he talks about it. He goes, think of it like a tax time bomb that's ticking, ticking, ticking.
And then the boom usually follows.
The boom, that comes at some point, yes.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
Well, I know this has led a lot of people to, even before Ed Slott came out and said this, a lot of people look instead for Roth IRAs. And I know that he makes a solid case for those as well.
Definitely. And the reason why they're probably increasingly preferred going forward, and again, this is all situational, and this is not for everyone. And again, we're talking to people that have done a great job of saving. If they're 5-10 years from retirement, they have $500,000, $750,000, $1 million, $2 million saved in an IRA or 401k. And they're looking at, hey, should we potentially fund some Roth IRAs? Should we contribute or should we convert? Well, why would they look at that? It's because the withdrawals when you take the money out are tax-free to you and your heirs. There's no required minimum distributions or RMDs during your lifetime. And there's no taxes due on inherited Roth withdrawals if the account was held for 5+ years. And so a lot of benefits going forward, and that's why they're preferred by a group of people. And they definitely work best for people that are in lower tax brackets now, those that are planning to leave wealth to their heirs, and people that are early retirees or folks with flexible income. Those we see that get the most derived value from Roth IRAs.
Definitely seems to simplify the process in many ways for folks. The problem, I guess, Scott, is you're working with a lot of people who I know Roth IRAs have a contribution limit. And especially if you have certain income levels, you can't use a Roth IRA at all. And so you're probably working with a lot of people that are in that realm. I'm thinking like the guy that's coming in to meet with you or meeting with you remotely on Friday with the $5+ million IRA. He's already got a big traditional IRA, can't contribute to a Roth now if he wanted to. I'm going to guess based on accumulating $5 million in a traditional, that creates some issues for folks.
It is. And having the preliminary discussion is that I said, hey, don't panic. Take a breath. I know you haven't had these discussions, with your current advisor, but it's really about looking at what are the strategies that potentially are available to you. And Walter, we have a checklist of strategies that we go through, and we sit down with a client or prospective client. We look and say, okay, what applies to you now or in the future? And it's not going to be one big home run thing. We're going to stack up 1, 2, 3, 5 tax strategies that layer on top of each other. They're like little hinges that swing big doors. So it could be we're doing strategic Roth IRA rollouts. And so we're going to, spread money from an IRA to a Roth through conversions over several years and to manage our tax brackets. We may look at using donor advised funds in early years, and if you're charitable, and then switching to qualified charitable distributions or QCDs once you reach 70.5, to really maximize your giving and take the most advantage you can on your tax return. And then definitely spending it strategically. Use your IRA for retirement income first, preserving other assets for legacy, depending on your situation. So again, you're not going to be able to probably dodge all the taxes, but you can choose when and how to pay them. And that's what a good comprehensive, not only tax plan does, but a comprehensive retirement income plan does is look at what are the strategies available and how do you deploy them to give the optimal outcome.
Well, Ed Slott is both a great expert when it comes to analyzing IRAs and teaching other people how to invest and save in them and understand them, but he's also an excellent marketer.
Yes.
And so, some of this, I think him saying this is the worst possible asset you can own. I feel like I could think of some worse ones, or at least ones that have gone more wrong than an IRA would go. So let's cut through some of that marketing fluff, if you will. Is it really the worst asset to own?
It could be for a segment of the population that have found themselves in a fortunate situation to be a good saver, maybe good investments, and they've got this large IRA or 401k. They're looking towards the future of retirement saying, hey, our lifestyle, we don't need all this money. It's going to be forced upon us. And now that we're looking at it, we're going to pay the same tax or higher tax that we were when we were working because it's ordinary income tax. A lot of people are finding their Social Security tax at the highest level. Some people are even finding out that IRMA surcharges are causing their Medicare to be more expensive, sometimes thousands of dollars per year because their income thresholds are so high. And so again, for a certain demographic that he's talking about, it's not the greatest thing for people. So definitely his advice is not one size fits all, just like ours is not. So for your retirement income, they can still be useful. For legacy, there are definitely better options to explore. So the key here is don't wait. Start coordinating your investments, your income, your tax plan, your healthcare, your estate. Coordinate all of those in one cohesive plan to make sure, hey, you can maximize and have the highest probability of success in retirement. And so again, have you thought about your IRA? How will it impact not only you, your retirement income, and your tax plan? How will it impact your heirs? And again, does it make more sense to pass those dollars on as a Roth or a traditional? Because ultimately, when you pass on an IRA, to your beneficiaries, there's going to be a tax bill and there's going to be the inheritance. So there's two components to it. So if you have 3 kids that are going to receive that IRA, it's going to be split 4 ways. Your 3 kids in the IRS. And you just have to be good with no planning. The IRS has a plan for you, no problem. They're going to take full advantage of those tax dollars. But proactive planning says, hey, we know we want it to go to these 3 kids or church charity kids. We know the IRS, there's some optional pieces in there. That's what good planning does. And so when you sit down with a good financial professional or someone on our team, you want to review your IRA strategy. What's your forward-looking tax review look like? You need to build a tax-smart retirement plan. And that's where we start with a 15-minute discovery call to talk about what's your situation, what's going on in your life, what are the details. We'll go through a 1 through 10 quiz to figure out, does it make sense for you to take another step and really engage looking at your situation? So again, 15 minutes, complimentary, no charge. And that's what you can do through the calendar link, call the office, shoot an email, any way that you're comfortable reaching out to us. We'll set aside time to go through your personal situation.
Just check the description of today's show. You'll find all those links and pieces of contact information. We've also got it displayed on the screen if you're watching on YouTube. If you're listening to the audio version, same thing for you. Just check the description or the show notes of today's episode, if you will, and you're going to find those ways to get in touch. I just went to the calendar link, Scott, to check and go to book my 15-minute call. I see some availability there, and so we're good to go. It took 2 clicks. I'm there, and
Easy.
I'm already feeling good about getting my IRA reviewed, especially after seeing that headline and wanting to get some more clarity on this issue. So thanks for breaking that down for us. Much
Absolutely.
appreciated.
My pleasure.
Yeah. All right. Thanks, everybody, for tuning in. We'll see you next time on Your Retirement Elevated.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.